Hi, everyone, and welcome to the part B of chapter number 14, which is accounting for the financial instrument. So in this chapter, what we try to understand is what is the derivatives? What is the different types of derivatives? Like what is the future contracts, options, interest swap, or the swap of a loan, then foreign currency swap. So foreign currency swap that we can cover in the next class with foreign currency chapter, the transaction with the foreign currency. So what is a future contract? What is a forward contract? What is the option? And what is a little bit about swap? So this is what we discussed in this lecture, and try to do some of the empirical questions for the future and the forward contracts. So normally what the companies do in order to secure their loan or in order to transaction internationally, for example, company A do a transaction internationally from Malaysia while sitting in UK. And these two companies from UK and Australia try to safeguard their loan or their transaction with the help of a broker. So what they do, they hedge their contract. For example, today the Malaysian ringgit against the US dollar is 4.40, which is today rate, and today rate is also called the spot rate. And in future, we know that there will be a fluctuation in the currency from 4.4. It may go up, it may go down, but we try to secure that risk. We don't want to take a risk for that contract. So for the broker, we say, hey, we will pay you 4.444. It is extra money what you want, but after 30 days, you're going to give us that's $100. After 30 days, you're going to give us on the same price of 4.4. So the broker, if agree, then we will pay him this much money to get our 100,000 after 30 days. And this whole transaction will be secure and it will be a risk-free from the fluctuation. Now, this process is normally called hedging. So there can be a different types of hedges. Two types we will discuss in this lecture. Number one is a fair value hedge. Whenever you have an asset, you can do the fair value hedging. Then we have a cash flow hedges, and then we have our investment hedges, which I give you an example just now. So what is the fair value of hedging? Use the hedge for the value of the particular asset or the liability. That is called fair value hedging. I will give you more detail in the upcoming slides. Then we have a cash flow hedging. Cash flow hedging means you try to hedge or you need to make secure that the future cash flow is smoothly given to your company without facing any other loss. So what we do, you do the hedging of the instrument. Now, what is the different things that include the fair value hedging and the cash flow hedging? So fair value hedging and the basic difference between that is that in the fair value hedging, whatever the profit or loss that we gain from this financial instrument, we just charge them into profit loss account. Whereas when we do the hedging using the cash flow, and of course we have to pay some money to the broker, and then we also see that in future when we have this contract done, what is the future value of that spot rate? So we do the calculation based on that estimate, and we calculate the profit or loss accordingly. So whatever the profit or loss come up in the cash flow hedging, first of all, it will goes to the equity part. In the equity part, it will go under other comprehensive income. And then you need to add the cost of the asset and the liability to that. And in the last, you adjust for the financial instrument to the profit loss account. So in the end, it will transfer to the profit loss account. Whereas the fair value hedging that directly goes to your profit loss, but in the cash flow hedging, it has to go through different steps. First equity, then the asset, and then the profit loss. So these are the three steps that you need to make while doing the hedging from this. So this is a very unique feature of the forward contract that normally you can do a formal contract with a forward contract with the other party using the hedging tool. Now, in this question, we will try to understand what is a forward contract, how this shape up, and after this, I will tell you the difference between the forward contract and the future contract. So let's dig into the question. So there is a company on 15 June 2018. It entered in a non-cancelable purchase commitment with another company that they will ship the goods on 30th June. Like after 15 days, they will ship the goods. The total amount of the price is 2 million, and it needs to be fully paid on 30th August. So after the delivery of the contract, which is on 30 June, they will pay the money, which is 2 million at 30 of August. And if I can calculate, it is after 2 months of the delivery, you have to pay 2 million to the party. Because there is a concern in the movement of the foreign exchange, because both companies are international, so they're concerned that there will be a change in the foreign exchange. So what we do on 15 June, they enter into a forward contract. So forward contract includes a broker who will deal with you, and they will charge you a little bit higher than the market, and they will do the hedging contract with you. So this is our financial assets. So in the last slide, what we have discussed, if you have a cash flow financial assets, so what you need to do is different process. First, you have to charge in the equity, then asset, and then profit loss. So they enter into a contract with a rate of $1 Aussie dollar is equal to 0.8 US dollar, meaning that you will get 0.8 dollar for each Aussie dollar. So meaning that you will get 2.8 will be payable to the foreign currency broker. Why? The rate has been changed. Now the latest rate, due to the latest rate, there is a 500,000 increase in the foreign currency. Why we need to pay a broker more than what is usual? Why we are not just paying him 2 million? Because this is his commission. That 500,000 is his commission. He has to charge extra towards what you have. So the forward rate is always more than the spot rate. Now, continuing the question, they say there's a different spot rates given every date. That there's a different forward rates are given. For example, on the day first they enter into a contract, there's a forward rate of 1 Aussie dollar. You will get 8.3 US dollar. Whereas if you enter into 30 June, 1 Aussie dollar will get you 0.81. So if there is a reduction in the value, it means the Aussie dollar is getting weaker from each year, from each date, from 15 June to 30 June. Same trend we have seen furthermore. So now for 1 Aussie dollar, you can just get 0.76 US dollar. So that on 30th of August. So each time we see there is a decrease in the spot rate. Spot rates means the actual rate on that particular date. Then we move further to the forward rate. So if we enter into the contract for the forward rate on the day first, it was 0.8, which we discussed earlier, which has a little bit decrease in the forward rate because there's a decrease in the spot rate, and normally it goes parallel with the market. There's one thing which is very sure that both currencies are have seen, both exchange rate has seen that decrease in the spot rate and the forward rates. So next date, it reduced to 0.78, then it reduced to 0.76. So each time you can see there's a reduction in the spot rate. Of course, on the last date, when we want to do a contract with the broker and the market is same, so there won't be any difference. Overall, the forward rates are less than the future spot rate. So why it shows that less than that means the remaining bigger amount is charged as a commission by the broker. So that's why the spot rates, you are not getting too much US dollar as compared, in the forward rate, you're not getting too much US dollar against the Aussie dollar as compared to the spot rate. So market rate is giving you more. And it makes sense. The difference is basically the amount which we pay to the broker. Now the question, given the designation of the cash flow hedge. So one paragraph I have added up here to discuss that. This is a hedge fund and this is a cash flow hedge fund. And we have to follow the hierarchy in each of this method. Like first of all, it will charge to the equity, then go to the asset value, and then last it will go to the profit loss account. So at the start, we calculate using the spot rate, like ways how much amount which is payable for each change in the spot rate. We start on 15 June. 15 June, there was nothing which is payable because that's the day when we enter into the contract. On 30th June, there is a reduction in the exchange rate from 0.83 to 0.81. Now we don't own 2.5 million, we own 2.469 million. So this is the reduction in the amount. This is the reduction in the amount payable as compared to the 15th June. Then on the 30th August, when we actually deliver the goods, the amount of spot rate was 0.76. So in this rate, we have to pay them 2.61 million. So overall, we start from 2.5. So the difference is 2.4 and 2.6 million will be the loss which we have done if the spot rate keep on dropping. And eventually since we are paying in the Aussie dollar, Australian dollar, so the overall amount will be reduced to 2.4 to 2.6, and we have to face a loss if we follow the spot rate. Now, if we follow the forward rate and we make a contract with our broker that, okay, we're agreed to enter in the forward contract with you, then from each dropping price, you can see there is a difference which is coming up. So on the day first, if we do our contract with him, the amount we need to pay is 2.5 million. So it's a 2 million contract. We are paying him 2.5 million, which is okay with us because it's 500,000 in some sort of his commission. Now, if we see that we go further to the contract, like we do our contract in the future for this forward rate rather than today, what will happen? So this rate has increased to 0.76. So if you divide 2.5 million divided by 0.76, you will get 2.564. So there is some sort of a profit you have gained on the fair value of the forward contract, which is 64,000. Then going further with the same rhythm, now the next is 2.63 million as compared to 2.564 million. And again, there is a fair value increase in the forward contract. So overall, we have gathered a gain on the forward contract if we stand on the day first and we do the enter into the forward contract agreement with the broker. So overall, we get a profit of 579, which is quite impressive that on the day first, although you are paying 2.5 extra, which is 500,000 more, but in the end, you are getting a gain of 131,579 US dollar, because that will secure hedge your fund for the future loss. So on that day, it was a good price to enter on the forward contract. Now let's see some of the entries. Amounts we have already calculated and taken from the last tables. You can have go through back and can see the values. So whenever we enter into a contract, there is a forward rate contract that will be debit. And first of all, we charge the gain on the forward rate, which is 64,000 taken from here, 64,103. So we enter to forward contract and we get our first gain. Remember, the first time it will go to the equity, then the same amount will be part of the asset, and that amount will charge to the inventory, the profit loss account under the other comprehensive income. And going further with that same amount, you will see for the next year, the next 30th August transaction will take place. So let's do first with this June transaction. So on 30th June, when we deliver the goods, we enter into our contract. We kind of get a gain from 64,000, which we debit into the contract and credit into the gain. Then there is a 2.46 million inventory, which is payable on 30th June. Let me go back. So 2.469 million inventory, which is payable on 30th June. So 30th June, inventory will be debit, foreign currency payable will be credit. So this is a payable because we need to pay for this inventory, whatever the inventory we buy from them. And in return, you have to charge it under the foreign currency payable. So it's more specific in the entry system. Now the third one is I tell you whatever the gain we have get, first we charge into the equity. So here is the equity part, and then it become a part of the inventory, and then you will charge to the profits. So 64,109 will be a part of here, which is cash debit and the inventory credit. So whatever we debit earlier, we will credit back for the inventory account, but we have to charge this into the other comprehensive income under the name of cash flow hedge. So that was pretty much it for this spot rate. We are going to the forward rate. For the forward rate for the 30th August, the gain is 64,000. Let me go back, 64,476. And then you have a gain called foreign exchange gain. So gain is like an income that will be credit, contract linked financial asset will be debit. This is exactly what we did in the last class. And then moving further, there was a loss recorded for 106,443. Then there is a loss recorded for 162,443. This is the overall loss of the spot rate. That will be debit, just like any other loss, and the foreign currency payable credit. In the last, when we do the transaction and forward rate has been converted into a bank, we will record that a forward rate will be credit and that there will be a debit in the foreign rate contract with the amount of 131,579. 131,579 will be on 30th August entry, which also includes the profit for the last year. So it combinedly, you will get a cash of this from the forward rate contract. In the end, you have to credit the bank account. Cash at bank will be credited with the amount of whatever we need to pay for the foreign currency payable. So there will be a debit of 2.6 million. Let me go back, 2.6 million. That will be a credit by 2.6 million, which is payable on 30th August by the end of the year when the money has to be paid for. So the calculation you can do are already calculation is in the table. Entry system you need to understand. First, we need to charge in the equity, then go to the payable, and then go to the foreign currency. Then we charge it to the profit loss account. Now, after the forward contract, we are moving to the future contract. Forward contract was kind of like private and customized agreement that settled at the end of the agreement and trade over the counter. Whereas the future contract is different, it's more standardized, like it is more deal with exchange item, where the prices settle will change on daily basis, even hourly basis. So this has to be settled with the contract in the end. So it's kind of standardized. So in this future contract, it can take any of these places. Like the future contract can be of bank bill futures, can be bond future, can be 3 years, 5 year, 10 year, or can be on stock, can be on exchange price. So there can be a different phrases which can be taken by the future contract. But you can see it mostly depending on the share and the bond values. So what is the share price index? Different indexes like top 20 companies, top 15 companies. We also speculate on the price of this 500 Fortune companies, for example. So what is the general entries here? I just write down the general entries. Normally the question will be done in the class. So first of all, you have to debit the future and you credit the cash. So you put some deposit into the future SIPs. Then afterwards, if there is a loss on it, so loss will be debited and portfolio share will be credited. If you put some gain on that instead of a loss, then you will get deposit with the broker will be increased, which is S&P broker or SPI futures, and credit will be gain on future contract. Just like the loss on share portfolio was debit, here the gain will be credit. Going further, if you get a cash and you try to sold out some of the shares of the future, so you will get a cash portfolio reserve account will be debit and you will get a credit on the share portfolio. This share portfolio will later on will be adjusted. Now, Next entry is to you deposit with the broker and you get a gain, and then you get the cash from that deposit from the broker. So these two are kind of like contra entry for each other. Option. So option means what is the put option, what is the call option. One of the students sent me an email, sir, I cannot differentiate between the put and call option. So put option is basically give the holder right to sell. Means the holder of that particular instrument can sell the underlying asset. So the holder in the put option is normally the seller. Whereas call option is opposite to that. Call option means the person has the right to buy that asset. So the holder for the call option is normally the buyer, and the writer for that will be the seller. So these are the few small definitions which is available in this options point. What is the option? What is the exercise price, spot price, a little bit entry system, and that's pretty much it from the lecture itself. Mostly it's given in the question form in your tutorials. So what is the exercise price? The exercise price is a price where the option has been exercised. It means on which date, what is the specific price you have put it for the special options will be given and considered as the exercise price. So some of the exercises they have given the entry system for the option is to record the instrument in the share option, is to first we debit the instrument in the share option debit and we credit the cash at bank. Then the valuation option or for the fair value will be investment will be debit and the profit on the share option will be credit. So you can see that in this chapter, what we try to understand is what is the future contract, forward contract, options, a little bit entry system for each, what is the different system that is involved in that. So that's pretty much it from this chapter. I will meet you in the next class. Take care. Bye-bye.